Good afternoon, everybody. Welcome to this week's Market Huddle. I'm Joe Lucey, CEO of Secured Retirement. Special guest this week, we've got Tim Sargent. He's the Director of Client Relationships at Sterling Capital. Most of you that have been working with us have probably been exposed to Sterling. They're a newer money manager that we've been using, but we've been very happy with the way that they've kind of held the form and what have you. So he's going to give us the good, the bad, the ugly about how Sterling Capital has been doing over the last 90 days. A little bit of a looking at the tea leaves. Where do we think that the markets are going forward? What are their financial analysts? What do they got on their radar? What are their thoughts on both the macro economy and maybe driving down a little bit on that too? So without any further ado, I do want to introduce you to Tim Sargent. As I said, Director with Sterling Capital. Before I go there, keep in mind that we may talk a little bit about some forward-looking guesstimates on where things are going. Anything we say shouldn't be construed as a fact. It's kind of our best guess at where things are going. Any past performance is not indicative of what future performance is going to be. And neither Tim or myself are members of the federal government. We aren't employed by the government, and we also are not CPAs, certified public accountants, or are we attorneys. So with that said, welcome, Tim.
All right, Joe, thank you very much. I really appreciate you giving us some time today. Everyone who is on, thank you very much. We really appreciate you giving us some time. Just a little bit about me. I have been with Sterling Capital now for, 17 years, and I have been in the industry for 24 years. Sterling Capital is headquartered in North Carolina, which is where I am talking to you from. But like everyone else who lives in North Carolina, I am from somewhere else. I am from the great state of Ohio. Please do not hold that against me, as I'm an avid Ohio State Buckeye fan. I grew up in Ohio first 30 years of my life. It is where I met my wife. It's where my two children were born. And it's also where I went to college. But the good news is I don't have to shovel sunshine when I live down here in North Carolina. So with that being the case, let's get into the meat of the matter. Unfortunately, this is a little bit of a busy slide, but briefly, just want to kind of give a synopsis of what happened over the past month, talk about how things went, and a little bit about why before we talk about what we think about moving into the future. So what happened over the past quarter? What happened in March specifically? A couple of different things happened. So broadly speaking, what we saw a rise in interest rates. I'm sure most of you are aware of that. Anyone out
Tim,
there?
Hold 1 second here. Are we? Can somebody let us know if we are now broadcasting live? It looks like Jim or somebody or Steven had a problem with the screen. Is it now broadcasting for us? Let me double check one thing. All good. Okay, great. Okay, have back at it, Tim. I'm sorry to cut you off like that, but I wanted to make sure everybody could see the slides here.
All right. Well, dramatic pause. I love it. That's fantastic. All right. So kind of back to what happened at the beginning of the year and then also in March. What we saw interest rates rise. I'm sure most of you who consume any kind of financial news or anything have seen that interest rates have gone up. If anyone here is trying to buy a house right now or refinance a house, certainly you've seen interest rates go up. So what has happened with that is there is an inverse relationship between yields going up, interest rates going up, and the price of a bond going down, right? So for example, as interest rates go higher, the value of a bond goes down. It's just kind of like a teeter-totter type of an effect. So as we saw interest rates rise, we saw the bond market get hit, and it was a pretty challenging market for bonds and fixed income, generally speaking, in the first quarter. Also in March, where we saw the Bloomberg Barclays Ag come in with a negative number first 3 months of the year. On the equity side of things, we also saw a little bit of change as opposed to what we've seen over the past several years as well. This phenomenon began a little bit in 2020 but it certainly continued into 2021, as we did see a little bit of a rotation out of growth stocks into more value type companies. And then also, specifically in January, we actually saw smaller companies actually do well versus their larger counterparts for the first time in a significant amount of time as well. It was certainly driven by a couple different reasons, but certainly as interest rates go up, generally speaking, not to get too nerdy, but what you want to do is find the present value of a company's future cash flows. You do a little bit of math with that. You have to have a discount rate. As interest rates go higher, that discount rate goes higher, which means that present value comes down a little bit. A little bit nerdy, but that's how we work. So we've seen a little bit of movement from some of those go growth stocks into some more traditional value companies. What do I mean by value? A value company is going to be more of a company that pays a dividend and so forth. So like financials, energy, things of that nature, as opposed to maybe some technology names, which are more growth-like. So that's what we saw really happen in the first quarter. Specifically in March, what we saw was the domestic market continued to do well. Actually, through the close of business, I believe Friday, the broader indice, we'll use the S&P as a proxy, the S&P 500, the market's up actually right around 10%, a little bit north of 10%, I believe. So the market has continued to rally throughout the year, the broader sense. The international markets have certainly not kept pace. The international indices have not done nearly as well. And then certainly we saw, again, value and small companies do better than their growth counterparts in that first quarter. Looking at the bond side, there were very few highlights in the bond market. High yield was positive, as were international bonds. Outside of that, it was a little bit of a challenge looking at the fixed income market. That's a little bit of a recap of what happened. So then let's take a look into, I guess, the tea leaves and take a look at what we see looking at some of the economic indicators and then what we think on a move forward basis. So what you can see here is a little bit of a snapshot of what the Fed looks at, looking at a couple different charts. You can see on the upper left, year over year, real GDP growth. Certainly, GDP stands for gross domestic product, which is our economy. You see the big drop there. That's not a surprise to anyone who has, I guess, taken a peek outside over the past 12 months. COVID certainly hit the economy hard, but as you can see, it has come back very quickly, very violently, and significantly better than most pundits actually said a year ago at this point. Looking to the upper right, you can see year over year U.S. industrial productivity. Production is the blue at the bottom. Productivity is the yellow on the top. Again, not a surprise. You saw production go down, but come back again violently and so forth. Something else I think is very interesting is productivity has actually gone up pretty dramatically as well. So for all those people who enjoy working from home, I guess that is an argument to have with your boss or your employer to say that certainly as a population, we have been much more productive if we don't have to get the road rage and have some of those frustrating times commuting to and from the office.
Huh.
And then the last one I want to take a look at is kind of the bottom right, which is the unemployment rate. Again, for anyone who's watched any news over the past year, not a surprise. Pre-COVID, it was truly one of the best employment place numbers of my lifetime. I'm 47 years old. Certainly when you flip the switch and turn the economy off, things get ugly in a hurry. But very similar to what we saw with production, the employment numbers come down, the unemployment numbers come down dramatically. And right now we're trading right around 6% or so. Certainly not where we were, but not as bad as some might think. What do I mean by that? Now, again, I'm an old man. I've earned all the gray hair I have. But what I can say is when I went to business school, I was taught that 5% unemployment was full employment. I mean, there was 5% of the population is just not going to be working. Certainly, that has been proven to be false, as we had employment numbers significantly better than that a year ago, actually a little bit over a year ago at this time. However, certainly at 6%, we're very pleased with how quickly jobs have come back, which certainly is good news across the board. Indicators, I don't know if you recall the conversation we had last time we spoke, but at Sterling Capital, we like to take a look at the indicators, but not all indicators are, I guess, have the same value. You have leading indicators, coincident indicators, and lagging indicators. So leading indicators kind of give us a glimpse into the future. They tell us in advance what it might happen with the economy. Coincident tells us what's happening right now, and lagging tells us what happened in the past. So certainly taking a look at the initial jobless claims, manufacturing, and housing, those are the numbers that are biggest to us. Initial jobless claims, it's slowing down a little bit, but still the employment numbers continue to improve. That's certainly a positive economically. Looking at the manufacturing, you can see ISM, Institute of Sales Managers. It used to be for PMI, which is Purchasing Managers Index. Essentially, any number above 50 is growth. Anything below 50 is contraction. And as you can see, manufacturing certainly above 50, and non-manufacturing, even more importantly, above 50, while posting a 60-plus handle. What that tells us is, again, both the manufacturing and non-manufacturing components of the economy are poised to continue to grow over the next time frame, looking into the future. And then housing, even though we did see housing permits go down pretty dramatically, housing is still kind of booming everywhere. You can't drive anywhere in North Carolina without tripping over a new subdivision. But we are seeing that could slow down a little bit with the rise of interest rates. And then certainly we're also seeing commodity prices rise. Out there trying to build a house right now, you know that shingles cost more, lumber costs more. Shoot, if you just go to Home Depot or Lowe's, you can definitely tell that something that cost not much a year ago is certainly much more expensive now. We're taking a look at lumber. So with that being the case, that could be a little bit of a headwind as we move forward. But essentially, looking at the leading indicators, we're looking at the economy, at least, moving in a positive or growth-like trajectory. All right. And then one more before I guess I get into what we think moving forward. Then also taking a look at the U.S. Treasury yield curve. Right, so if you take a look at the yield curve, the blue is where we are right now. The dotted lines are where we used to be. In fact, the one that's more flat in bottom is where we were a year ago. So essentially, interest rates have gone up dramatically over the past year, and then certainly dramatically so far year to date. And as I mentioned before, that's really because of inflation expectations, right? So if people think there's going to be higher inflation, then certainly you as a bond owner would demand or want more interest to kind of offset some of the inflation that might eat into your interest rate. So that's when you see interest rates go higher. And because of that, again, we've seen growth stocks not do quite as well as their value counterparts throughout Q1. So with that being the case, what do we think on a move forward basis? That's part of those are the indicators. What we think on a move forward basis is kind of on a macro level, kind of a top down level. We do believe that we're going to be more neutral between stocks and bonds. We're overweight stocks versus bonds essentially since this time a year ago. Early April last year is when we went overweight stocks versus bonds. Certainly that worked out well. We do think that domestic markets are going to do better than international markets. And then within the domestic space, we feel that large value and small value are poised to do a little bit better. So we actually are slightly overweight, kind of in a macro sense, to large value and small value. So how does that really, I guess, move into what we're doing with our focus equity portfolio? Our focus equity portfolio was in line with its index for the first quarter. Even though there are inflation expectations and we have seen interest rates go higher, you can see right there in a chart below, we do feel that inflation expectations are a little overdone. Any reaction in the market, it seems to be an overreaction, either on the positive side or the negative side. I don't want to get too nerdy talking about tips, break-evens, or some of the other numbers that are out there. But essentially, historically speaking, inflation is very mean reverting, meaning it reverts to its mean, it reverts to its kind of historical average. So we think that the inflation fears are a little bit overblown. So with that being the case, We still like growth stocks, specifically domestic, and we're very pleased with how we're positioned on a move forward basis. So I have talked for roughly 15 minutes, Joe. I think I should hand it over to you.
Well, let's do this. One of the things we wanted to have prepared for today, part of the reasoning with the timing of this was we were going to have a 2-page consumer approved handout on the Sterling Focus Growth Portfolio, which as I started off the presentation, some of you have that already, and some of you may want to consider bringing it into the portfolio. We don't have through the first quarter yet. We should have that in the next day or two. So if you see that email there, the info@securedretirements.com, if you send an email to us there and just say, hey, please send me the Sterling Capital Focused Growth brochure. We'll have the newest up-to-date one that is just getting through the compliance here in the next day or two. I'm guessing we'll have it before the end of the week, huh, Tim?
Yes.
Okay. So we'll get that off to you. Before we take some questions, why don't you give us a kind of a elevator discussion? What is the focused growth portfolio? Tell us about the money manager, what the goal is there, and you know how that model works in the Sterling Capital repertoire, the Sterling Capital group there.
Yeah, thank you very much. Yeah, so focused equity. Let's just say we're not the most clever people when it comes to naming something. So it is a high conviction or focused type of portfolio. Meaning we like to have anywhere between 20 to 30 names, generally speaking, in the portfolio. The reason for that is the math. I'm sure most people have heard, well, an active manager can't outperform the index. Well, a lot of the reason for that is you see a lot of active managers that have 200, 300, 400 holdings. And all of a sudden, if you don't like a company, you have to own it. You just underweight it. Or if you like a company, you really can't own a lot of it. So all of a sudden, the math works against them. With a more high conviction type portfolio, historically, we have a higher active share. Again, another nerd statistic. But it historically gives us the ability to outperform. And historically, we've had success with that. Again, anyone who has the most recent product profile in front of them can see those numbers, and then certainly we'll get them out to you as quickly as we can. Colin Descharme is the lead portfolio manager for that. He is a bright guy. See, not only does he have his CFA charter, but he's also a CPA. I believe he's also a rocket scientist, and I mean that. He actually has a degree from MIT in some sort of aeronautical engineering or something. So let's just say that he's a little brighter than I am. He's the lead portfolio manager in that particular portfolio. He's been managing it since inception. And again, historically speaking, they have done a great job versus their index over the past 5 years. It is actively managed, although it has relatively low turnover. The reason we have relatively low turnover is we like the stock ideas to kind of play out what he owns. Also, what that means is there's less trading costs. And then also, it's also not by design, but a byproduct of the lower turnover, more tax efficient as well. So we're very pleased with it, Joe, and thank you very much for asking.
Well, no, and you guys have done a fantastic job. Those clients that have been in it, I would attest to that. You know, again, if you want to email us, info@securedretirements.com, we'll make sure we get you an updated report on how they've been doing historically. Also, I did activate the request. If you'd like to schedule some time with a team member here at Secured Retirement, you can just click on that box and it should go to a calendar feature. We can get it right on the calendar right now. We're happy to have a 15 to 30 minute phone call about what Sterling does, or even just any other questions you have about your portfolio or how we're doing for you here at Secured Retirement. So are there any questions out there? Otherwise, we can kind of probably wrap things up. Tim, talk a little bit about if I was looking at a year from now, what do you see out of the stock market, the S&P 500? If I'm looking back, it's December 31st. Let's go to January 1st of 2022. Looking back to today, April 9th or 12th, I guess. How has the market done?
Yeah, so that's a great question. So first of all disclosures, no one knows for certain. But that being the case, take a look at the tea leaves. Our forward-looking analytics tell us that we do believe the stock market, the equity market, is going to be higher than it is today. But that being the case, we do think there's going to be volatility between now and then. And we also believe that the returns are going to be a little more muted as we move through the year than they are right now, right? If the S&P is up 10% so far right now, you annualize that out, that's a strong, big number. We do not think that's going to happen. So we do think there's going to be some volatility. We do think that equities are going to be higher at the end of the year. But we do think that it's not going to be as robust as we have seen so far year to date.
If we haven't seen any questions, how about we just go ahead and wrap it up? If you do have questions, concerns about the portfolio, anything that we're doing here with you at Secured Retirement, please do not hesitate to email us or click that feature there, and you can get right on our calendars. Tom Winkler asked about the difference between Sterling, which is an all-cap concentrated portfolio, and MPMG, which is Minneapolis Portfolio Management Group, another money manager that we've been using, Tim, here, that's more of an all-cap value concentrated portfolio. You kind of hit on that a little bit earlier, and I don't know if you have any other comments around it, but really growth has been more, tends to be a little bit more higher towards technology. A lot of the companies are going to be kind of those companies that we might see changing the way we do things. Think of Amazon, which is in your portfolio there. A year ago, we got an Amazon package every other week, and now it seems like I'm tripping on a package every time I walk in the door. There's a whole lot there around Amazon and actually what they control around hosting commerce and such on the internet. But can you talk a little about more of a concentrated all-cap growth versus a concentrated all-cap value, and maybe how they kind of work together a little bit?
Well, I think you really hit the nail on the head with that last comment, which is they really complement each other well, right? So when growth does well, value is not going to do as well, and vice versa. And I think that's why it's good to have a combination of both when you are working with your clients. But if you're taking a look at more of a growth portfolio, some of the names you're going to say, like certainly Amazon's one, Microsoft, just names that are more technology centric, have much faster earnings growth, much quicker growing companies, whereas value is going to be more financials, more energy, more dividend centric. One's not necessarily better than the other, but it's nice to have both of them in your portfolio as you go through an entire market cycle, because again, over the past few years, growth has done well. We've seen a little bit of a rotation here really since about August. But historically speaking, growth has done well with it. And if you do believe that we as a country and as a civilization are going to continue evolving with different technologies and so forth, it's a great place to be. I mean, at the end of the day, if you think about how quickly things are changing now compared to where they changed even 2 decades ago in 2000, things are changing much more rapidly. So as we embrace and keep working with technology, and really the pandemic's pushed a lot of technology forward 3 to 5 years quicker than people thought. The technology we're using right now, that has certainly been a big catalyst for growth companies doing well.
One thing I would add to that is that, when value does well, growth tends to do well as well. Boy, that didn't sound right. Maybe not just as well. And on the other side of that, market has a correction here this summer. We're going to get wet whether we're in value or growth. The S&P 500 to the portfolio that you have versus a portfolio that's more value-based. We're going to get wet when the market has its corrections. But overall, I think long-term, that's how we can limit the exposure to some of that risk, making sure that we're always working with money that we have long-term plan. I'm going to let you answer Kurt's question here real quick, kind of the short answer to how many portfolios does Sterling have? And then maybe you can touch on the stimulus that's come out here for Bob, and then we'll wrap everything up here.
Yeah, how many portfolios do we have? So as a money manager that we manage directly, I don't have the exact number. I'll call it just north of 30. if you take a look at bonds and stock portfolios. And then regarding stimulus, I guess was the second part of that question.
Right. Bob asked, how will sterling, I think really, how would large cap growth be affected by the $2 trillion, $2+ trillion? Maybe he's talking about more the spending plan, the infrastructure plan, but maybe we can just talk about the stimulus and what that's done to the money supply, and then any additional stimulus, and how do you see things working out that way, and then we can wrap up here.
Yeah, so very quickly, what I can say about the infrastructure deal, I guess I'm old enough to remember when $1 trillion was a lot of money. $1.1 trillion is, I guess, a lot of money. So certainly that Wall Street has never seen a stimulus or spending package it did not like. So there will be long-term or intermediate-term ramifications, but short-term, that will certainly be a positive sugar high for the market. The way that it's infrastructure is being defined right now, it's not necessarily just roads and bridges. There's also lots of other things being included in a package like that, and that could potentially be very positive for some technology names and so forth as they try to get broadband, internet, all kinds of other parts of that particular bill passed and through and so forth. So overall, it should be very positive on the short term. And then certainly any money that's getting put out with stimulus is very positive short term for the market as well. Again, Wall Street's never seen a stimulus or spending package it didn't like in the short term. Long term, we'll see what kind of ramifications we have. But the good news is we have the Fed there, and we do think that the Fed's going to keep rates where they are for at least the rest of the year. At least that's what Jerome Powell said on 60 Minutes yesterday. And we believe that inflation is not going to go as crazy, at least through the rest of this year, 21, as some people are saying. We might have a little bit of an uptick next year.
Well, as we wrap up here, just a couple reminders. If you send off that email to info@securedretirements, we'll make sure we get out that report that I was talking about earlier, specifically on the focus equity portfolio, the focus growth portfolio of sterling, so that you can look at that. If you'd like, you can indicate that you'd like to schedule a call. That's by hitting that offer on the bottom, asking for the Tax Smart Retirement Review. Whether you're a client of ours or somebody that's not a client yet, feel free to utilize that, and let's schedule some time to update you. Finally, next week we have Minneapolis Portfolio Management Group, the value side of the Sterling Capital story. So a little yin and yang there. We'll kind of compare the two, what each side is thinking. But with that said, I hope everybody, we were doing great with the weather, and all of a sudden it's kind of slowed down. But I hear that there's more warm weather on its way here, and we're going to get out of the 50s and back into the 60s and 70s. And hopefully, if you're a golfer, you can get out for another round or two in shorts soon. With that said, we're going to wrap it up. Everybody have a great rest of your week, and we'll be back next week with another Market Huddle right at noon on Monday morning. Have a great Monday afternoon. Have a great day. Bye-bye.